Welcome to Front Range Facts. This is Anthony Meisner.
And this is Jim Arian.
We're here to give you your national market update today. So, what's going on, Jim?
Well, we wanted to cover three main topics today, Anthony. Number one, wanted to talk a little bit about new construction versus resale home trends in the national market. Number two, a lot of people ask, is there an election effect? What's that going to be meaning to the housing market? So we wanted to dive into a little bit of what historic trends look like. And then number three, wanted to bring you a few different national market updates that are kind of fun factoids to know.
All right, so let's talk a little bit about resale versus new homes. New homes here are actually trending down in price enough where they're actually a little bit cheaper than existing homes on the market, and it just doesn't usually happen.
No. In fact, for all the groupies out there that have followed us since 2018, when Anthony and I first started doing the show, you'd know that in 2018, in fact, new homes cost 30% premium over resale homes, and the historic average is closer to actually around 15% premium for new homes construction versus resale. And so this is the first time that we're seeing cheaper prices, and it's not just a function of shrinking the house down to make it a smaller, cheaper house. It's literally price per square foot is about $3.50 cheaper to build new construction than to buy a resale home right now.
Yeah. All right. So let's talk median price per square foot versus new. Just like you said, $3 a foot difference. Well, look at this. Versus where we are, where price per square foot is pretty expensive. They're building at $213 a square foot, and that's really not terrible.
Mm-mm.
The fact that it exists, or I'm sorry, they're building at $209 a square foot, right? Existing
Yeah.
is $213. That is really fascinating. There's a few factors here though that we look into, right? So look at this right here. This is price per square foot, discount versus new in comparison. It is not the same across the nation, right?
It's shocking to actually see the discrepancy, right? Because like that yellow stuff is all where new home prices per square foot are less than the existing. So Denver, $17.30 less per square foot to buy new construction over resale, which is pretty remarkable. And then to see like in San Diego where it's $57 cheaper per square foot is just phenomenal. And there are some parts of the country where it's actually still cheaper to go to the resale route, but overwhelmingly right now nationally it's an inverted trend that every now and then pops up, but it's a pretty rare thing historically just to see it, especially at this level.
Absolutely. Now, 1 in 3 homes on the market today are new construction. So this is significantly more than the average we've seen in a long time. And that happens to be why so much of this. It's really just supply and demand at this point.
It's a very much a tale of that. The fact that there are a lot of just, the fact is like nobody wants to sell their existing home because they have fantastic interest rates. So the new construction is where all of it's at. There's an oversupply essentially of it, driving the price down, making those builders very aggressive with a lot of their incentives.
Absolutely. So the main reason is new construction is cheaper, right? We talked a little bit about this, but let's just give the highlights here.
Yeah.
Number one, existing home prices were up 52% during the pandemic. They were not up that much for new construction. They were really only up about half of that.
Yeah.
So that right there alone is definitely reason number one. I mean,
And like the other thing too is everybody has been talking to us here in the market about God, I like new construction, but the fact is the lots are so small now.
Yeah.
And that's true. I mean, the trend has been, let's put a few more parks into a neighborhood and let's just shrink the lot size down so people play outside in the parks, get to know their neighbors. But it's a dramatic difference, right? I mean, 460 square feet, smaller than in 2018. That's a pretty good sized chunk of lot right there. And then, builders of existing, homes have, lot sizes that are 1,900 square feet larger on average than those are purchasing new builds now. So it's a difference of 1,535 square feet since 2018.
Right. Absolutely. And then the other thing is, if you look at number 4 here, condos and townhomes represent a smaller portion of new construction sales since 2018 as well. Condos, I mean, we see this in Colorado. We're building nearly no condos.
Yeah.
It looks like that's a national trend. Condos only represent 3% of all new construction sold versus the 10% they did in 2018.
Well, and it costs so much more to, the price per square foot on a condo is a lot larger, right? So that also brings that average up if that product existed. And since it doesn't really exist, that's another reason why the prices have been dropping for that.
All right, so let's talk about this seasonal change, right? This is more of the election cycle information, right? Normally we see about a 10% drop this time of year just because of normal consumer behavior, but it looks like in election years it's actually closer to a 15% drop.
So, yeah. I mean, like that's the thing is we get asked all the time, like, is there an election effect? What does this president's campaign mean for the market? A lot of people, on the boots on the ground, we don't necessarily feel much of a difference, but here it is, looking at historic data from 1963 to 2019, there's a 6% difference in sales volume. So
Yeah, I mean, that is definitely substantial, right? And we don't normally see that or feel that, but it definitely is taking place. Now, if you compare election years versus after election years, this is some really promising information to look
mhm.
at. So look at that. If 1980 to current election years, there's your sales. But afterwards, look at the increase. 9 out of 11 times you saw a huge bump in sales. So going into next year, this is really an additional light at the end of the tunnel for this. This is great.
I think if you're in the business, the real estate business here, you should be fairly bullish about what the next 12 months looks like. We've been in a very deep trough. The real estate's been in a recession, regardless of whether the country has.
Right.
And so I think everybody is kind of feeling like we're past the worst point. It's
Mhm.
not like we're going to go back to 21, 22 with gangbuster prices or anything like that. There just isn't, that market anymore. But we are going to start to see prices gradually start to rise, as well as sales volume increase.
All right. So what about new homes
Well,
versus?
no, new home prices went up in last 10 out of 11 elections as well. So expect to pay more next year if you buy a house. It's not going to be a ton, but one to I think the most bullish people are about 5% increase in price by the
Exactly.
end of next year.
All right, so let's look at mortgage rates. Mortgage rates decrease as leading up to 8 of the last 11 election cycles. And so you can see here, it's very nominal, right? This is no extreme swings in interest rates, but it is definitely a common trend to see right before an election, interest rates start to dip just a little bit.
Well, it's already in effect right now. I mean, we're seeing, I saw headlines where 30 years gone under 6%, but I'm not seeing any lender offering less than about 6.4, 6.5 right now. So,
Exactly.
but still, I mean, it's way better than it was where we were breaking 8%, just a few months ago.
Yep, actually. All right, so let's look at the national report. So what does this say?
Well, so mortgage rates, as we just been talking about, have been, dipping down and down and down. And so we're at 6.4% roughly today. And, when the Fed meets on September 18th, it's pretty much guaranteed they're going to be dropping rates
Mhm.
at least 25 basis points on the 10-year treasury. Some people even, figure it might even be a half a point, given the fact they've delayed it so long.
Yeah, I think leading up to that, we're definitely going to see that be baked into the 30-year fixed rate by then. But that's a good sign because there's a lot of downward pressure heading into
But
this
what's going to
market season.
happen is September 18th, when they drop the rate, the market's going to overreact, and it's going to be. I guarantee you,
Yep.
between September 18th and September 30th, the cheapest interest rate of the year.
Yeah,
That's what I feel.
be exciting. All right, so what about demand based off of rate? Because this is one that's really exciting to see. We've been in very weak demand or limited demand for a
Mm-hmm.
long time. We're finally getting into a stronger type demand, maybe a demand that is at least maybe acceptable for buyers.
Yeah. And if
Yeah.
you're a longtime watcher of the show, you know that Anthony and I have defined that green means good. And as you can see, we're getting closer to green.
We like
So,
green.
once we get below 6%, that's where economists really feel that that the interest rate doesn't really impact buying activity. Once it's over 6%, there is, some level of impact on buying activity. And of course, the higher the rate, the more of that impact.
Yeah, it's also just like that green screen that keeps popping up behind us. Green is good, so we wanted to show
Yeah,
that.
it's a good way to sell a flaw going on there. And so here to put this into real dollars, we wanted to show you what a little bit of what that impact looks like on the difference in interest rates. And so in this illustration, we had interest rates that were in April of 7.5%. Now it's at about 6.4. So that's about $400 roughly a month in savings. So that's a significant amount. And when we look at it over the 30-year loan, $135,000
I mean, that
difference
is
in
an
price.
absurd amount of money just for the course of that
1%.
1%
One
drop.
percent is over $100,000 impact. That's nuts.
Yeah, it is. All right, so look at median age of home buyers. This is the one that really shocks me, and this is very concerning, right? Because as interest rates hiked over the last few years, you can see that the average age of a first-time home buyer is up to 35,
Mhm.
right? So that's way more than it's been in years past. It's way higher than anyone wants to see it. But look at those repeat buyers. They're 58 years old right now, and they represent obviously the vast majority of buyers out there.
Yeah, in fact, there's been this remarkable trend of an increase in down payment amount of almost, back before COVID, it was like 10% down was pretty much average. We're now at like 18.6% down is what the new average is,
It's a lot
and
of
it's a
money.
direct function of the fact that more people who have equity who have lived in homes are now moving up or moving down, but they're putting more down payments in, and then the average buyer, because those prices have gone up so much, has increased dramatically over time from about 32 to 40, or from about 30 years old to 35, over last 40 years. So it's remarkable change.
Yeah, it is. All right, so look at this. The 1 year change in active housing inventory for sales shifts between basically over the last year. So check this out. The West, which is where we saw a lot of that appreciation, 45%.
Mm-hmm. Yeah, Colorado has seen a pretty good jump in inventory. Not as bad as Florida, but
Not as bad as, Arizona even.
yeah,
Like there's
yeah,
some
but
definitely big ones here.
you can feel it in the market where there's just stuff that's less of staying on the market for longer, and we continue to see a greater volume of new homes coming on the market for sale.
I actually can't believe that there's a couple of states on here with negative numbers.
Especially Vegas. That blows me away. I mean,
I
just
know,
Nevada
it's
in
bizarre,
general.
right?
Yeah.
All right, so look at unemployment rates. The one big thing about unemployment rates is, average over the last, what is that? Basically since the last 70 years or so, employment rates are at 5.7%.
Mm-hmm.
There were definitely a time and a place where we had higher unemployment rates during the pandemic. But I think the big trend here is unemployment rates are finally rising, which is a really good sign for a slowdown in the economy. But we're nowhere near those old averages, right? So
Mm-hmm.
I think this is a good sign for the strength of the economy, but yet at least maybe we're heading in the right direction here. So I think that's a good trend. This is actually where the Fed is actually looking at unemployment rates far more than they're looking at inflation right now because they don't want to slow down the economy too much.
And it seems like their inclination is to stay below the historic average, anyways, too, because they're starting
Absolutely.
to freak out, by the number of jobs that are not being built.
Yeah, absolutely. All right, what is this?
So, according to Goldman Sachs, they're this small little company you probably never heard of, but they're predicting that basically that they're going to see a 25 basis point rate cut in September, November, and December. So, a total of 0.75 total. But if the August unemployment report is also weak, then a 50 basis point cut will become likely. And it has come out, and it is weak, relatively speaking. So it wasn't terrible, So the odds of a 50 basis point cut, or at least probably 40%, I'd say, coming up for September 18th.
Yeah, it's pretty exciting to see. We've been waiting for it for a very long time. It's finally coming around. Now, in 2025 home price forecasts, this is what Jim was talking about a second ago. There are definitely some Moody's or Freddie Mac are pretty negative about price appreciation. But I think the vast majority of people out there trying to predict this stuff, they're really seeing some really interesting stuff here. Now, 4.4% from Goldman Sachs is a high, but an average of 2.7% price appreciation over the next year really is not bad.
No, and I mean, it's going to be somewhere, nationally, probably about 3% is what I'd probably, peg it at. But, it's not going to be huge. But, expect, though, this coming spring with the interest rates being lower, with all that pent up demand, you're going to see a pretty good amount of over asking price offers. Probably not hugely exuberant, but it's certainly going to be where all the price increase for the year happens is in that spring, early summer market.
Yeah, absolutely. And it's really going to chip away at that inventory level, right? Because that inventory level has been rising for a couple of years. And as interest rates are coming down, we're going to eat away at all that. It's going to take a good year or two for that before we are back to a pretty wild market. And I think that's what everyone's worried about, right?
And we do often see a cycle of people wanting to start getting out as buyers, early in the year, like, end of January kind of time frame. And then they get on the market and they don't see a lot for sale in February, March, so they bid things up. But we're going to have an overhang of inventory heading into this next year. So it's going to be interesting to see. It's probably going to mute that, amount of over asking price in multiple offer situations, but it's going to be strong still.
Absolutely. All right. So let's talk a little bit about what's going on in Summit County because it ties into some other data we wanted to talk about.
Yeah. So, thanks to our friend Scott Starman over at Cornerstone Realty in Breckenridge. Shout out to Scott. He just shared with us this land title data that we found pretty interesting to illustrate kind of the next point we're going to make, which is just, what the 30-year appreciation of a home in Summit County has done over time. And this is all property types, so single family, townhome, condo type of things. And, as you can see from there, if this green screen wasn't acting up so much, which I blame my partner for because he was so much about wanting to do that. Okay, now it's giving us a haircut. But basically, if you duck for a second, Anthony, just so they could see the first number. So, here you start, basically in 1988 at about $100,000 for the average price of a property. And now we're at, 1.258. So, a 12x, return on your investment
Right,
since
35 years.
1988, that's phenomenal.
Unbelievable.
Yeah. And so this is where we run into a problem now with the government, right? Because our bureaucrats, even though there's over 500 representatives in the House and the Senate has 100, they apparently don't understand that you need to create laws that index to inflation. So they hard code numbers like capital gains being $250,000 for one individual or $500 for a married couple. And now, since that's been around for 30 years or so,
Yeah, it's way crazy.
We used to have just a rare things where people would have to pay for this appreciation through taxes, and now it's 13% in Colorado is what people are paying. So 13% of people that are selling are having to pay capital gains tax right now. So it's a huge problem because it's another reason why people are not selling. They don't want to pay that huge tax. And so this is going to continue to be an anchor on the market until the government starts to index this to inflation and starts to put it into today's monetary terms.
Absolutely. All right. Well, thank you so much for joining us today. This is Anthony Meisner.
And Jim Marion.
If you want to reach me, my phone number is 303-968-9868 or ameisner@ltgc.com.
And you can give me a call at 303-548-0243 or shoot me an email to jim@ourcoloradohomes.com.
Don't forget to check out our other updates. We do a Colorado update and a local update here on 4 Range Facts.